Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, day traders, from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:13 a.m. Central Time, and I'm recording this in preparation for the market day of July the 9th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, we've got a lot of material today, so let's dive right in. First of all, from the morning reading, the plunge in Chinese shares continues. Emerging markets near their test of the 2015 low. Canada stocks are falling on weaker commodities. Energy shares are threatened spring low. Rising VIX raises risk level for stocks. Dow and S&P 500 end back below their 200-day lines. The free fall in Chinese stocks continued again today. Chinese stocks traded on the mainland and on Hong Kong lost over 6%. The FXI ETF has fallen well below its 200-day moving average and trendline support drawn under its 2014-2015 lows. The FXI has retraced two-thirds of its previous advance and is in deeply oversold condition. The plunge in China had a bearish effect on the entire Asian region, which includes a -3% loss in Japan. Heavy Asian selling continued to weigh on commodity prices and currencies and stocks tied to them, and to countries that produce commodities like Australia and Canada. Emerging markets are taking the biggest hit of the day. In addition to China, Brazil and Russia are suffering from the fallout of the commodity markets. And we can take a quick look here at that chart on FXI, and it is really quite breathtaking. Remember how parabolic this move was earlier in the year, and we talked about it at that time. When you see these parabolic moves, you've got to move to protect in some fashion, whether you're buying puts, you're peeling off shares and scaling out, but you got to book those profits, because often these parabolic moves are followed by a parabolic retrace. And while this one consolidated for a period of time, and it looked like at first that we might just simply get consolidation by time and then perhaps another leg up, once that broke and you had that breakdown right in here, and then especially if you weren't out by then, when you filled the gap and then that broke, you see we came down to the gap fill and we bounced off of that area, but then once that broke, that should have been your absolute sign to get out. And you look what happened here since. Now overnight, and we'll see this when we get to the morning report, it had a big recovery, but you know, a big recovery after you've already fallen like this, you know, doesn't necessarily mean that it has found a bottom. You know, indeed, we had a big up day here just to fall the next day. And these, look at these gaps. I mean, with overseas ETFs, you often have gaps. It's just part of life and trading with those markets. But these are very large and violent gaps. So let's continue with the morning reading. Emerging markets near critical test of support. EEM lost another 3% today. The weekly bars falling more than 7% this week and moving dangerously close to last December low at 36.42. The EEM is also testing a rising support line extending back to 2011. Downside violation of the fourth quarter low would be very bearish for emerging markets. Asian stocks with close ties to China accounted for some of the day's biggest losses. That includes South Korea, -2%, and Taiwan, -4%. Commodity producers also fell, with Brazil and Russia losing 3% and 4% respectively. Needless to say, a technical breakdown in emerging markets would increase downside pressure on global stocks in general. And we can take a quick look at that chart. That's just flat out ugly. And look at this. You know, it opened below this important swing low and just continued to fall. So very bearish action on emerging markets. We'll continue with the morning reading. Energy spider threatens March low. Speaking of energy, they remain one of the weakest parts of the stock market. XLE threatened its March intraday low at 72.84. It has already broken a rising trend line drawn under its January to March lows. A breakdown in energy stocks would be another bad sign for crude oil, and it won't be a good one for Canada and other commodity producers. On a day when all market sectors are lower, energy and materials are the two weakest groups. Today's biggest material losers are aluminum and copper stocks, which reflect weakness in these two industrial commodities. Think about copper and aluminum. They're often looked at as signs of economy strength, and when they're falling out of bed, it says an awful lot about what the expectation is for the industrial economies of the world as you go forward. So another very, very bearish sign here. The VIX moves higher. It's normally a caution sign for stocks when the VIX index is climbing, and it is. The VIX closed today just shy of the 20 threshold. Moves above 20 usually raise the risk level for stocks. Since the October 2011 peak, each VIX trough has been lower than the previous trough. That has supported rising stock prices. Notice, however, that the trough formed this May was higher than the one formed last summer. This may be an early hint that the trend of the VIX is strengthening. That bears watching, since a rising VIX usually translates to lower stock prices. And you see in the past, most of the time when we, in recent past, had gotten up here around 16 or so, that was usually about it. But this time we're popping up here around 20, and we've done so multiple times, not just one day and done. So this may be portending for something more. Let's see here. And back to the reading. Yesterday's stock rebound didn't last very long. U.S. stocks traded sharply lower today and fell back below the 200-day moving averages. The Dow Jones Industrials ended nearly 200 points below the 200-day average. The S&P closing below its 200-day line as well. The U.S. stock market is holding up better than foreign shares, and it is giving back grudgingly, but it is giving ground. The weight of the technical evidence continues to suggest more selling ahead. Wednesday indeed marked the first time in more than 100 days that the S&P 500 closed below its 200-day moving average. We looked at all such occurrences since 1929 in a November 2012 report, I should say. Short-term forward returns were a bit weak, but a month later the S&P was higher 80% of the time. It also rallied after that occurrence and again in October 2014. Failure out of 27 occurrences was right before the crash in 1987, and more along those lines. More than 93% of the volume in the New York Stock Exchange was concentrated in stocks trading lower on the day. That's the second time in 6 days, coming within 3 months of the S&P 500 trading at a 52-week high. We've seen this kind of focused selling pressure 6 other times. Every one of them rallied over the next month by at least 2%. And 5 of them marked major lows. Measured by a handful of metrics, the Shanghai index of stocks has entered panic territory. Over the past 15 years, that panic has not equated with an exact low in that index, as it tended to test the panic in the weeks ahead. So we've had an awful lot of bearish signs here. We talk about China. We talk about the S&P 500. And remember, we had that big wick, and we thought, whoa, that's a very bullish reversal kind of pattern, but then immediate rejection. And in fact, if you look at this, you have basically a rounded top followed by a broken trend. Then you have this potential, fall through this level here, which marked the 50% fib retracement. That left a huge bullish reversal, but then was immediately nullified and backfilled. So, was that a reversal to trigger the bottom, but no, immediately nullified. So continued weakness pretended ahead. And yet if we look at the ES, which is our S&P futures contract, look what happened overnight. So I mean, look at this cluster of the most recent candles, and this includes overnight action. So we have our breakdown, but then immediately a huge bullish candle, another candle with a huge reversal, a huge backfill, and then last night we're well up over halfway through that candle now. So obviously when the full cash market comes in and we get all the participants, the question will be, where does that go? There's an awful lot of signs right now of significant bearish breakdowns across multiple markets. And it's most important when you're doing technical analysis, one indicator showing something, that's interesting. But when you get a whole bunch of indicators showing very much the similar outcome but taking different perspectives, that's far more powerful. And whether we're looking at EEM, EFA, FXI, which is China, those last two emerging markets and developed markets, of course the American market, everywhere you look around the world, you look at commodities and energy, everything is bearish. The only thing that has really been standing out with some bullishness has been bonds, and obviously they've been unwinding in anticipation of the Fed action. But now you have some bullish, moving to safety kind of action with those long bonds. But is that a place to be able to hold for any period of time? Because as soon as people feel confident, they're likely to exit those positions and not put themselves in harm's way of that unwinding action. Now, with the Fed actions from yesterday, we'll continue to probably see some delays in actually raising those rates, but those rates going up are inevitable. So those TLT bonds will face a lot of pressure going forward. The other place that's traditionally talked about as safe haven is gold, and you see gold is not performing as a safe haven. It's acting more as a basic commodity and has had weakness along with everything else. So a lot in the charts, a lot in the morning reading today. Let's go ahead and bounce quickly over to our regular reports and summarize them. As you saw in the four broad market indices, all up about 1%. You had crude oil up about 1.5% last night so far. The euro down about 0.25%. Dollar down about 0.5%, and gold down marginally. And overnight action, much like you've seen in the United States, where you had the big bearish action yesterday, same thing in China, but then that's followed by huge overnight up, as well as in Hong Kong. Japan, not so much, but still positive at 0.6%. Germany, 1.5%. United Kingdom up 1%. In terms of macroeconomic reports for today, you got an FOMC member speaking, and of course the regular weekly unemployment claims. And tomorrow's action, I don't see anything on the U.S. in terms of an orange or red flag report. In terms of our volatility conditions, we did put in standard deviation moves on all four broad market indices yesterday, with the NASDAQ putting in an over 2 standard deviation move. So while we've not had a lot of days with an open to close putting in a standard deviation move in recent days, when we've had them, we've had some pretty big moves. And you look here, 2 here, 2 here. So there definitely is kind of a pop in the step of the volatility, followed by periods of compression or not achieving much, at least during the intraday action of late. Short-term VIX up over 20 at a 20.96. You see IV percentiles all pretty much mid-range, with the Dow being the highest at a 79. And on our daily report, we continue with phase 5, break of diagonal horizontal support, very bearish. IBD status holds on to an uptrend under pressure. I have to believe that that is at the very edge of that status and could go into market incorrection with another distribution day count increase or two. Accumulation distribution C and D plus respectively. GMI index actually fell to the last notch to a 0 out of 6, strengthening that sell signal. And you see the stock chart status on the decision points, very, very, very poor looking in across all the various markets. The intermediate term market posture, strong bear. So we had a one-day flip followed by a one-day flip back to strong bear. You see the S&P just above severe status. NASDAQ the same, just above severe status, as is the Russell. Only the Dow was weak bull after yesterday's action. Our current threshold status for hedge warning is level 2 plus. So right there between level 2 level 3. Level 3, of course, being a crash warning, not a promise, but a warning of elevated risk conditions. And we continue to have these very elevated risk levels. Clearly, market is justifying increased risk levels, and these are the kinds of conditions that lead to the potential for very violent down moves, and you need to be aware and protect yourself against those kinds of days. That does not mean it happens. It just means that risk is elevated. This should have been in red, but actually a number of warnings fired yesterday. Market and decline warning, sharp increase warning. VIX spike has recently fired. We are over an 18 on the VIX. We had a squeeze fire. We have a high distribution day count with a 7 on the S&P and 5 on the NASDAQ. Skew actually okay, is not signaling a severe imminent down move. Look at this New York new low, 660, and this is even with the market that was closed part of the day on the New York Stock Exchange. They had technical problems. And then of course our risk aversion indicators still flagging all risk off, and I took a closer look at those yesterday, and they're not even starting to look like they're forming any kind of bottom, so that might indicate that there's more weakness to come. Option income strategies, really very poor conditions for option income strategies, covered calls or put selling at this point. You should be first and foremost primarily concerned with preservation of capital until better trading conditions present themselves. But aggressive traders, obviously there is opportunity with that volatility. You just have to really know what you're doing and be position sized accordingly. For example, on option income strategies, as that VIX goes up, you can take smaller position size and have the same profit potential that you would have had, with a lower VIX like a 12 or something like that. In terms of sector-specific activity yesterday, see a lot of red here. Only consumer staples, green on all 3 time frames. And you see on the percent change yesterday, 1 day, 5 day, 1 month, 3 month, year to date, even 1 year. Many of these sectors are full out really bearish trends and really nothing to that you want to stand in front of with an enormous amount of capital at this point. So just kind of keep all this in perspective. It's not just, oh, we've been weak for a few days. We've been weak for a while, and there is no consistency even back to the year to date. While healthcare is up for the year to date, it gives it back too when you enter into a full out bearish market. And you certainly have the hallmarks of many of those traits of a bear market that are in place right now. We talked about that rounded top and that broken trend, and then the even the reversals failing yesterday. So part of this could be resolved, obviously, if Greece is resolved, and headline news is very, very, very high right now. You could have a huge rip up, and remember that some of the biggest days ever are actually in full out bear market. So we could always have a huge rip up. and could be triggered by some sort of headline coming out, such as a Greek resolution. But until we actually form a bottoming pattern and reversal patterns and flushing and end of trend patterns, we're not likely to see a stable bottom. So we've got to see that bottom be put in and then supported and confirmed, and then ultimately, given our current action, we need to be able to see that we don't just go back to the prior range, but that we actually break out of that range in a confirmed way. So we've got some real healing to do before you can confirm a bullish market posture in this current circumstance. So a lot on the plate today, but hopefully you're making the moves with your portfolio to be well prepared, and part of that hopefully is with information that you've gained from here. If you find what we're doing helpful, we appreciate you liking us on YouTube, and then of course at the same time, if you came to us from Twitter, retweet us. If you didn't come to us from Twitter, certainly you can follow us on Twitter, and you see the tag at Falcon Global LLC. Stock twits can be found at Falcon Global Trader, and then of course our YouTube channel can be also subscribed to, and that makes it easy to know when we actually get published each day. So a little bit of a long report today, but a lot of content, and hopefully you found that of value. Disclaimers as always, hit the pause button if you need more time to review this, and we'll see you back here tomorrow before the market open with the market preview. Good trading.